In general, stockholders' equity has two primary accounts, capital stock and retained earnings. Although there are other factors that can influence these accounts, the basic equations we will discuss in this course are as follows. Beginning capital stock plus issuances of capital stock minus repurchases of capital stock equals ending capital stock. For retained earnings, beginning retained earnings plus net income or minus net loss minus dividends equals ending retained earnings. Increases in capital stock result from investors contributing resources to the business in exchange for ownership shares. Capital stock decreases when capital stock is repurchased from investors by the business. The beginning retained earnings balance represents all net income from the beginning of time up to the beginning of the period, less all dividends from the beginning of time up to the beginning of the period. It effectively represents all of the internally generated equity financing that the owners chose to retain in the business. When a business is profitable, its current period net income is added to the beginning retained earnings balance. When a business is unprofitable, its current period net losses are deducted from its beginning retained earnings balance. When dividends are paid out to stockholders, retained earnings decrease. You should note that the beginning capital stock and retained earnings balances come from their ending balances from the prior accounting period, because whatever you end with in one accounting period, you will start with the next accounting period.